Welcome back. We are watching markets and earnings this morning, looking for a rebound in stocks after a 200-point sell-off yesterday on the Dow. The Dow Industrials today looking up 200. Investors worried about an intensified trade war with China really was the story yesterday. But will a strong earnings season be enough to right this ship? Bank of America's Keith Banks joins me right now. He is the Vice Chairman of Global Wealth and Investment Management and Head of Investment Solutions Group. And Keith, it's good to see you always.
Great to be here.
Thanks for joining us.
Thank you.
Your characterization of the markets here. Would you be poised to put new money into stocks right ahead of the second quarter earnings period?
We would be, Maria. We're still bullish on equities, but I think you have to also understand we're late in the cycle. So our expectation is you'll get returns that probably are more closer to the longer-term return profile of the country. So think nominal GDP, so 5%-ish, plus a 2% yield, 7-8% returns we think are probably realistic going forward.
Wow, wait, nominal GDP, 5%-ish, you just said.
If you get 3% real growth, we think in the second quarter you're going to get 4%, but that's not going to sustain. And then 2% inflation, you're at 5%, then throw some yield on top of that. It's still a pretty good return at this stage.
Big number, Lindsay Bell.
Yeah, I mean, what has been weighing on the markets, I think, from my perspective, really has been these trade conversations. And we see the market whip around based on the topic of the day. But the industrial sector is one sector that really has been hurt by the talks. It's down about over 3%. Is the third worst performing sector within the S&P 500. But the early reporters have actually had really good numbers, beating on both the top and bottom lines. And their stocks are reacting really well to the reports. Do you think this is just a beaten up sector and this is one of the sectors you can get involved in now? Or do we still have to wait for this trade stuff to play out?
Well, look, I think in general we're going to see a lift in the equity market. We think the second quarter, when we print the strong GDP number that we expect to print, when the earnings come out, and importantly, in addition to earnings, because I think people do expect a strong second quarter, it's going to be the guidance going forward on top of that. But we think that could be a catalyst for people to move back into equities, in addition to the fact that buybacks are incredibly strong. You know, what's been interesting, too, is we've seen 7 hikes by the Fed. So 175 basis points. But the irony has been the U.S. economy has remained strong, but is decoupled from the rest of the world. The pressures have been manifested more in Europe and Japan. And so we're seeing a decoupling from the standpoint of stronger growth in the U.S., stronger financial flows, and just greater stability. So it's been an interesting dynamic that's played out here.
As you're looking forward to earnings here, one of the big stories of the last year is this rising economy and the demand for labor, companies having a hard time finding workers, which normally would suggest they've got to pay more for them. We've seen wages coming up a bit, but maybe not as fast as people thought in the government reports. Are you expecting in this earnings season companies saying, look, compensation is costing a lot more now, or you think that's still pretty restrained?
Well, you know, if you look at average hourly earnings, they bottomed in 2012 well below 2%. We're back to the high 2s now with an upward trajectory and we're basically at full employment. The key is going to be this. You've got to watch productivity, because if we see productivity increase, and a big driver of productivity will be capital spending. We think capital spending could be up 10% this year. Then if productivity lifts, you can absorb as a company higher wages. If productivity doesn't lift, then higher wages will be problematic for companies in terms of profit margins, and also the Fed from the standpoint of higher inflation.
Just a question, Keith. I understand where you are in the second quarter and where B of A's directive is. But the second half of the year, I'm a little more nervous because when I look at it with Fed hikes, possible gas price increases, and the trade rhetoric becoming actually real trade impact, you could see this kind of slowing take effect, you know, where organic growth of these companies slow pretty dramatically.
Well, look, you know, there's always kind of pulls and pushes when you're in an economy as dynamic as ours. But, you know, in our view, the combination of the strong growth, our economy will be, the engines will continue to be CapEx and incredibly strong consumer. We have a thriving small business community. which we all know that's where jobs really get created. And we've got an incredible tech sector that continues to drive growth. There will be things to worry about. That will be one. Trade talk will be one. There could be a policy error. This is not going to be a, this is not going to be a straight shot higher. But we just
because there is a narrative out there that at some point things do slow down. Even in the end of 19, there were some expectations that we're looking at growth of under 2%. But you don't see it now. I mean, because we're looking at 20% earnings growth through the second quarter and 4% economic growth. Right. What would be the most important metrics that you're watching to see how slow things get, given the life and length of this recovery that we're talking about, 10 years?
Yeah, I mean, so we just eclipsed the second longest expansion. If we get to next summer, we'll eclipse the longest expansion in the history of the U.S., which was the 90s.
Yeah.
But to your point, Maria, what we're more worried about, we feel good about the U.S., and don't forget, we still have more deregulation coming.
That's right.
The fiscal stimulus is helping. Again, strong consumer, strong CapEx. We're more worried if this comes to an end, if this long bull market comes to an end, we would say right now, we would think it'd be more due to what's happening in Europe and elsewhere. Europe, can Europe withstand the tightening of financial, the financial tightening going forward? They don't have the same fiscal levers, or not willing to pull the same fiscal levers that we have. So we think that the catalyst could be more Europe than the U.S.
And maybe emerging markets, too, because they've obviously taken a sharp move down. Good chart in the Journal today about copper. What is copper telling us with this huge sell-off that we're seeing? Because copper is typically an indicator of global growth, but it's been plunging.
Yeah, it's interesting. Certain things, there's some disconnects here that you'd say, why wouldn't copper be strong, given what we're seeing, especially now with growth here in the U.S.
It's probably the trade issues, right?
Yeah, I think that's probably most reflective of that. But again, we think as time goes on, if the economy continues on, then copper will be more reflective of that.
What about the flattening yield curve? That's
I was just
what
ask
everyone is talking about. How do you address that?
It's really interesting. If you look at the big anchor right now on long rates in the U.S. are global rates. You look at the 10-year Treasury versus the Bund versus the Japanese 10-year bond. It's just an anchor. It's hard for it to get going, number one. Number two, the U.S. and the U.S. Treasury continues to be the place people run to if there's any uncertainty. So part of that, I think, is distorting the flattening of the yield curve somewhat. But, we're keeping an eye on it, but we're not anticipating an inversion of the yield curve. If it gets inverted, that's a different ballgame. But right now, we're comfortable. And we also think, too, that as inflation begins to tick up, as the Fed continues to unwind, because don't forget, they themselves have said they're buying over the years, probably reduced the long-term rate by almost 100 basis points. Mm-hmm. So we think there are some factors that could allow the long rate to go up and maybe get a steeper yield curve, but it's something to keep an eye on.
Yeah, I mean, we're going to be talking about that tomorrow when the banks report. Right. Not Bank of America, obviously, but we got JPM and Wells Fargo and Citi tomorrow. Any thoughts on this sector? These stocks have really not done well going into the earnings period. Yeah, I can only speak generically, but I will say that that's one of the sectors that we continue to like, along with technology. We would still avoid the bond proxies. With rates going up, we think they're going to go up in a controlled manner, but they're going to go higher. So the bond proxies, we think, will continue to stand under pressure. We'll leave it there. Keith, it's always a pleasure. Thanks so much for weighing in. Keith Banks there.